Hello, everyone, and welcome back to Wall Street Trends. Today, we're talking about something that has rocked the financial news. Warren Buffett, often called the Oracle of Omaha and one of the greatest investors of all time, has reportedly fully exited his positions in SPY, SPDR S&P 500 ETF, and VOO, Vanguard S&P 500 ETF. These two ETFs are some of the most popular ways for everyday people to invest in the S&P 500, the main benchmark for the U.S. stock market. If you've been following Buffett, you might recall that he's long recommended the S&P 500 index as a solid choice for the average investor. So why would he suddenly sell out of these funds? In this whiteboard animation, we'll explain what SPY and VOO are, explore the possible reasons behind Buffett's exit, and break down the lessons that regular investors can learn. We'll also look at some real-life examples from Berkshire Hathaway's portfolio, like Apple, AAPL, Bank of America, BAC, and Coca-Cola, KO, to see how Buffett typically invests. By the end, you'll have a clearer view of whether this move spells trouble for the market or if it's just business as usual. Let's dive in. A quick look at Warren Buffett. First things first, who is Warren Buffett? He's the CEO of Berkshire Hathaway, BRK.A, BRK.B, a massive conglomerate that owns companies like GEICO, BNSF Railway, and stakes in dozens of well-known stocks. Buffett practices value investing, buying shares of companies he believes are undervalued, holding them for the long run, and benefiting from their growth. Over the decades, he's built an incredible track record, which is why every investment move he makes gets major attention on Wall Street. What are SPY and VOO? So, what exactly did Buffett exit from? 1. SPY stands for SPDRS and P500 ETF Trust. It holds the stocks of 500 large U.S. companies like Microsoft, MSFT, Amazon, AMZN, and Tesla, TSLA. It's one of the oldest and most traded ETFs in the world. 2. VOO. This is Vanguard's S&P 500 ETF. Like SPY, it tracks the S&P 500, but often at a lower annual expense ratio, making it a favorite for long-term investors seeking minimal fees. Both funds are recommended by many experts because they provide instant diversification and have historically grown alongside the broader market. Buffett himself has famously suggested that most people would be better off investing in a low-cost S&P 500 index fund rather than trying to pick individual stocks. Why is Buffett leaving SPY and VOO? Now, if Buffett believes in the S&P 500 for the average investor, why would he remove these ETFs from Berkshire Hathaway's portfolio? Here are a few possible reasons. First, concentrated bets. Buffett prefers to own a handful of companies he deeply believes in rather than spreading money across 500 stocks, some of which he might not like. For instance, Berkshire has a giant stake in Apple, AAPL, and also big holdings in Bank of America, BAC, and Coca-Cola, KO. By exiting SPY and VOO, Buffett might be doubling down on companies he finds most promising instead of holding every component of the index. Second, market valuation concerns. The S&P 500 has soared in recent years, largely thanks to tech giants. Buffett might see parts of the market as overvalued. Selling index ETFs could be his way of freeing up cash to take advantage of deals if stock price is correct. Third, tax and portfolio strategy. Berkshire is a huge institution with complex tax considerations. Selling SPY or VOO at specific times might be part of a bigger tax strategy or a routine portfolio rebalance. Sometimes, large investors use index funds as a temporary place to park cash. When a better opportunity arises, they exit these broad funds quickly. 4. Direct ownership and control. When Berkshire invests in a company, it often takes a big enough stake to influence management or get insights into operations. You can't do that with an index fund. Owning Occidental Petroleum, OXY, or Chevron, CVX, directly, for example, lets Buffett engage more closely with those businesses. Lessons from Berkshire's major holdings. Buffett's current investments offer clues about his strategy. 1. Apple, AAPL. This is Berkshire's largest holding. Buffett admires Apple's brand loyalty and constant cash flow from its products and services. 2. Bank of America, BAC. Buffett loves stable, well-managed banks and sees them as foundations of the economy. 3. Coca-Cola, KO, a timeless investment with a strong global brand held by Berkshire for decades. 4. Chevron, CVX, and Occidental, OXY. Berkshire has ramped up its energy exposure, suggesting Buffett sees value in oil and gas companies amid market shifts. These choices reflect Buffett's preference for owning fewer, higher-quality companies rather than a broad mix that includes weaker businesses. Does this signal a market crash? One big question: is Buffett's exit a sign of an impending market crash? The short answer is not necessarily. Buffett is not known for predicting short-term market swings. Instead, he focuses on long-term value. Exiting an index fund may just be a tactical move, raising cash, reallocating to other sectors, or waiting for better deals. While it's true Buffett tends to sell overvalued assets, it doesn't mean the entire market is doomed. It could simply mean he sees better ways to invest Berkshire's vast capital. Always remember, one investor's sale does not automatically imply a bubble about to burst. Takeaways for individual investors. What should you do if you're holding SPY or VOO? Here are a few points to keep in mind. 1. Buffett's scale versus yours. Berkshire deals with billions of dollars and can influence big companies. You might not have the same motivations, resources, or constraints. 2. Simplicity still works. Buffett has repeatedly said that most everyday investors are best served by low-cost S&P 500 index funds. This stance hasn't changed just because Berkshire sold its ETF positions. 3. Stay focused on fundamentals. Whether you invest in individual stocks or index funds, look at key metrics like earnings, cash flow, and competitive advantage. 4. Long-term horizon. Buffett's success comes from thinking in decades, not days. Selling your ETFs because of short-term market news can derail a well-thought-out investment plan. Could Buffett be redirecting funds we know Buffett might be reallocating cash to? 1. Treasury bills or bonds. With higher interest rates, holding short-term government debt can be more appealing now. 2. Undervalued stocks. There may be companies or sectors like energy or industrials that Buffett sees as cheaper compared to the broader market. 3. Future acquisitions. Berkshire may be preparing to buy another large business outright, something Buffett loves doing when he spots good value. Remember, Buffett's goals for Berkshire can differ greatly from the goals of a regular individual saving for retirement or another long-term objective. Final thoughts and conclusion. So, why did Warren Buffett just fully exit SPY and VOO? Most likely, it's a strategic decision reflecting Berkshire's specific needs rather than a complete shift in Buffett's belief about index funds. While the headlines make it sound dramatic, it's crucial to remember that Buffett consistently recommends broad, low-cost market funds to everyday investors. Berkshire's sale could be about freeing capital for future opportunities, refining its portfolio to a few key stocks, or simply following internal tax and asset allocation strategies. For individual investors, the main takeaway is, don't panic. Index funds still provide broad diversification and remain a core component for many long-term portfolios. If anything, take a lesson from Buffett's overall philosophy. Focus on fundamentals, invest for the long run, and avoid jumping to conclusions on short-term headlines. Thank you so much for watching Wall Street Trends. If you found this video helpful, smash that like button, share it with friends, and make sure to subscribe for more market insights, stock analysis, and investing tips. Until next time, stay informed, stay patient, and keep investing wisely. Disclaimer: this video is for educational purposes only and should not be considered financial advice. Always do your own research or consult a qualified financial advisor before making any investment decisions.